Democracy That Delivers is brought to you by the Center for International Private Enterprise. Now, to your host.
Hello, everyone. Welcome to the Democracy That Delivers podcast, produced by Center for International Private Enterprise. My name is Kathy Tai. I'm the Deputy Regional Director for Asia and Pacific at SIPE, and it's my pleasure to welcome my co-host, Eric Hans. Eric, you want to introduce yourself?
Hi, my name is Eric Hans, and I'm the Director for the Center for Accountable Investment. We're excited here, Kathy and I, to have two great guests with us today at a company called Free World Investment. Larry Chan and Daniel Wong, both co-founders, both managing partners at this interesting investment strategy. And Larry, Daniel, why don't you say hello?
Hello, hi. Yeah, thank you, Kathy and Eric, for having us, Daniel and I, for having this podcast. And yeah, to introduce myself, I have been in the financial industry for over 25 years. I work globally. I started working in New York to begin with, but also got opportunity to work in London and Hong Kong in my career. And I'm glad that I started Free World Investment with Daniel just recently, about like a couple of months ago. And that's what we're going to share more in this podcast.
Thank you, Larry. Daniel, you want to say a few words about yourself?
Sure. So I'm Daniel Wong. So I'm also a managing partner and a co-founder of Free World Investment. This is actually the first human rights and this is the first investment strategy based on human rights and democracy and freedom. So basically, I'm also currently a Washington D.C. based due diligence and geopolitical risk analyst here. And before, when I first came to America, the Hong Kong protests broke out. So I have been working with several different groups. I've also co-founded several pro-democracy organizations in here. And then we try to actually advocate American support for Hong Kongers fight for democracy and freedom. So actually, I met Larry about 2 to 3 years ago during a campaign called Hawkers for US. Basically, it is actually a mass distribution campaign because at the time, we are thankful that America actually passed the Hong Kong human rights democracy law. And when the pandemic hit the US, we were thinking, how can we as Hong Kongers really give back our gratitude towards America? So basically, we started this kind of like mass distribution strategy. And that somehow me and Larry clicked because I'm a due diligence guy, I'm a research guy, while Larry has been in the past, have been serving for JP Morgan for the past 5 years. So we were thinking, how do we actually expand our endeavor for promoting Hong Kong and also to let people know what is geopolitical risk in investing in authoritarian regimes. And that's how we founded this Free World Investment.
So that's a very great introduction. And I'm just wondering, I have simple questions, for our audience. Is this an investment fund or is it like a company that trying to provide services to guide investors to reduce geopolitical risks? What it is?
Yeah, it's an investment strategy that would allow the investors to actually own a portfolio of stocks, and then the stocks would belong to all these companies that do not have a lot of exposures in some repressive countries. So it's not just like a concept, it's actually a real portfolio that had an inception date of May 2nd this year. So it has been investing in the US domestic market for over 6 months already.
And I'm curious, what prompted you to start this investment strategy? I mean, this sounds great, but what was the trigger that encouraged you, or you feel like, oh, there's a void to fill or a vacuum to fill? What prompted this?
Yeah, so I've been working, as I mentioned above, for over 25 years. And the United States actually has pretty good retirement and investment concept. So I've been always putting in certain amount every year into 401k. And I have been kind of pretty conservative. So I've been doing the majority of the investment in just say S&P 500 or some other large cap investment funds. So I thought it was all good, right? Until a certain point, I realized that, hey, a lot of US companies actually heavily invest in certain countries that are having heavy geopolitical risks. So, for example, Russia and China, especially in the beginning of the year, we realized that domestic companies, right, if they have a lot of exposure in Russia, they would actually like be totally like impacted by their exposure, and also like the stock prices would go down. So I was thinking about, oh, in that case, right? I didn't even think about that. I didn't know. And most of the investors would not even think about that when we are investing in US domestic stocks. We would actually have a problem with all these exposures. So I was trying to think about how I can take away all those exposures. And that's why we start with like free will investment to have a portfolio that would avoid that kind of country risk.
And Kathy, like I would like you to also follow up with your question here. I think it's a brilliant question here. So I think it's more like both personal and more like a global level first. So more like personal level first. Like I was born and raised in Hong Kong until I got master in LSE for international relations. At the time I did at that time everything talk about the Belt and Road strategy in China, right? Belt and Road initiative, and Hong Kong is not. I would say Hong Kong is actually one of the first city states that actually experienced one of the really economic colonization by China, or what they call a United Front strategy. What is happening here in America is not something new. It had always happened in Hong Kong in the past, few years after Hanover. But by the time when Hong Kong actually signed its first free trade agreement with China, they call it CEPA, and there's a lot of economic incentive followed by the political oppressions that we've been seeing with all those targeting of the Hong Kong's freedom. Is actually all beginning from the Chinese free trade agreement and stuff like that. And at the time, Hong Kong has been less being economic independent. And until now, I have to say that when I want to bring the level from a Hong Kong's perspective and to tell America's investor about what China is doing right now. So basically, what happened in Hong Kong is not just Hong Kong. We're seeing what happened in Hong Kong now expand to global level. Right now in Ukraine, and maybe next one will be Taiwan. This is actually an economic disintegration, or I would call the economic there is no longer the economic globalization is no longer here in place. It's decoupling right now. So we're seeing that even here in America, to the ordinary investor, for example, if I buy a jacket from H&M, for example, at least I have a choice to choose whether it's made in China. But imagine people have their own pension plan, 401k plan, 1/4 or 1/5 of a salaries goes to countries that they don't even know. They might be thinking about they might be just investing in the American stock market, but actually there's a lot of indirect investment made by these American companies into China. And a lot of somehow these Chinese companies, they're actually currently sanctioned by the United States. So right now there's actually involved a lot of human rights abuse, and this track record has been horrible. So what we're trying to do here is that, are we really living in a free world? If we are living in a free world, isn't that investment should be really something that is truly freedom of choice? But this is not the case. So before I go on, I think I can also explain a little bit about the current situation of the geopolitical risk here that we're facing here in the United States. So not sure if Larry has something to add first about the current exposure to China. Okay, so basically as part of the free world investment strategy here, we actually we have seen the current geopolitical risk here. Let me give you some explanation. Even before the Ukraine war, a lot of these Wall Street funds, like BlackRock, Vanguard, State Street, for example, right? They have thought about the rising gas and oil price will be it's offered some sort of positive omen for for investors to pay to Russian equities. And they never actually thought US or EU would kick Russia out of the SWIFT system. And they thought because of the rising gas and oil price, there will be increase in the Russian equity price as well. And at the time, only in March 2022, BlackRock actually have outlined they have suffered 70 billion worth of loss in the Russian equities. And this is actually the geopolitical risk we are seeing right now. Or even for Chinese exposure, BlackRock, for example, its CEO said China is the area of significant opportunity, and they even encourage investors to triple their allocation to China. They've been advocating MSCI to further invest the Chinese A share to the emerging market ETFs. And for example, Bridgewater, they're saying they have launched the new China fund worth of $468 million through its Chinese-based subsidiaries in November 2021. And the same case goes to other firms like Blackstone as well. And what we're seeing here right now, these are the ETF that is actually being tracked to indexes with related to China. And there's a lot of actually indirect investment into Chinese companies. And a lot of these companies actually have involved in horrible human rights abuses in Xinjiang to monitor its Uyghur population for the concentration camp as well. And the more horrible case would be related to the U.S. pension funds. As of 2021, there are 6 leading U.S. pension funds have a combined holding of over $6 billion last year, and subsequently have lost hundreds of millions of dollars as a result of the exposure. I'll give you one example, like in California, CalPERS, right, which is the largest state pension fund in the United States. 2 to 3 years ago, it was actually being under the scrutiny of Bank Meng, who previously saw China's $3 trillion in its current reserve. But the thing is, this Mr. Meng is a recruit of the Chinese Communist Party 2010 programs used by Beijing to attract overseas talent back to its country to serve its Chinese government. And the same case goes to endowment funds as well. 12 largest U.S. college endowment funds have the average around a third of its portfolio managed by private equity firms. And there's a lot of this, and this is actually the transparency is not very clear here. And in the case of Duke University, for example, nearly 60% of the holdings are private managed, and a lot of them will be going to China. And do people actually have a choice and even have the awareness to know about their investment, the passive investment being involved in China? That's not the case. And that's why we're thinking, what about we can start something that we can actually offer investors all over the globe a freedom of choice, a genuine freedom of choice that can actually invest in countries not related to authoritarian countries like China, Russia, Cuba, Venezuela, for example.
That's really so. Where are you pulling your companies from? Is it just S&P 500 companies? Is it just American listed companies? Or do you have, European listed companies as well, via American markets on ADRs? So where is the pool of investments that you're screening from?
Oh, okay. So we are actually not starting from scratch. We are working with a company called Running Oak Capital that has been running a pretty good and stable strategy for quite many years. The founder father actually founded the strategy about 40 years ago, and it has been performing well compared with S&P 500. And right now the portfolio has about 400 million asset under management, AUM, and they have about 50 to 60 stocks in the portfolio. So what Daniel and I have been doing is that we look into every single company in the portfolio, and then we assign what we call FWI, Free World Investment Score, to every single company. So Daniel probably can talk about the criteria that we use. So basically, just say our score is from 0 to 100 points. If a company is 50 points or above, then we will include in our free world efficient growth portfolio. If it's under, then we are not going to include. So that's how we actually invest in a subset of the portfolio that Running Oak has been managing. So that's how we construct our portfolio. And Daniel, would you like to add to talk about the criteria that we use to come up with the FWI score?
Of course. So right now, Free World Investment is actually working with Running Oak Capital, as Larry has mentioned. The original portfolio have about more than 70 companies. They are companies mostly with undervalued companies with relatively lower PE ratio. And our job is to add on an additional layer of research about geopolitical risks. So basically, we have 3 criteria in our research methodology. First, sourcing. We want to know how much these to what extent these companies have their materials, employees sourced from these authoritarian countries, like China, for example. How many asset infrastructure they build in China, how many people they hire. And the second criteria would be how much would they earn from authoritarian countries. That would be the revenue. We look at their annual report, we look at the media monitoring, we do open source research. We even have conducted field investigation, discrete investigation as well. Because we also have the assumption, because if they have too much revenue in authoritarian countries like China, for example, right, their stake will be too high. When the stake was too high in China, they might go just like in between the U.S.-China economic decoupling. The situation here, they might have said something in the rhetoric that in support of in support of the Chinese Communist Party, for example. And that's how we actually come to our third criteria, which is their political score. We want to know their attitude towards authoritarian regimes like China. One example is like maybe Tesla, right? Elon Musk, right? That famously said, notoriously said like a few weeks ago that he thinks it's a good idea for having Taiwan as one of the special administrative region. But we would all know that how many factories or how many people actually hired by Tesla in China. And that's how we come to the conclusion that somehow we would think that as a Hong Konger, I know a lot of activists have been lobbying American government, British government in support of Hong Kong or other free countries. But it seems that a lot of corporates, Wall Street firms, they are still trying to play in the middle of these two, between the free world and authoritarian countries. It's like 1936, 3 years before Second World War. A lot of U.S. Wall Street firms, they're still pumping money into Nazi Germany. So what we're trying to do is to change status quo here. So with all these and with all those sourcing, revenue, and political score, we come up with what we call the FWI score, Free World Investment Score. For companies only with that actually pass the threshold, the minimum requirement of these three scores, that we will actually include them in our Free World Efficiency Growth Portfolio, FWEG. And right now we actually have the results right now since inception date. Since our inception in May, we actually have outperformed the market pretty much. So as of October 31st, 2022, our portfolio have actually outperformed the S&P 500 total return index by 6.38%. And in 6 months, the S&P index actually declined by 6%, around 6%. And the same period, when Nasdaq 100 QQQ total return dropped by 12.4%, our portfolio actually outperformed by 12.75%. Of course, disclaimer, the past performance is not necessarily an indicator of future results. But I have to mention that right now, in the past, we've been thinking between the dilemma, right? That's the dilemma here about asset investing and wealth management. And because of the economic decoupling between US and China, or I would say between the free world and authoritarian countries, we might have the best of both worlds, where investors can actually avoid the moral hazard while they can actually outperform the market. And that's why with our portfolio here, we would like to present to investor that, hey, we can actually talk about human rights in wealth management, and you can actually also keep your pocket safe as well.
Yeah, I mean, it's really interesting. I think that if I want to kind of summarize what you've said here, it seems that companies are trying to pick your metaphor, have their cake and eat it too, in terms of relationships between authoritarian regimes and democratic regimes, but also the old metaphor saying is that if you're standing on two boats, you're going to get wet, and so there is risk inherent. And I think that's perhaps what free world investment is trying to show, is that there is potential risk out there in a different geopolitical context, in a world of decoupling or regionalization, or I saw yesterday something called slowbalization rather than globalization. So there is this change in international commerce and investment, and I think that what I'm hearing from you is that free world investment is trying to measure that risk a bit more, and that being very well coached by your lawyer, by the way. Past performance is not indicative of future results. So you are showing that there is some material benefit to investing in democracies and limiting exposure to autocratic regimes. That's two very important points that I think that you've made there. Kathy, did you have any questions?
I also agree with you that I think, from the investor side's perspective, we should definitely reassess the exposure to higher risk countries. I think that's something that some people wanted to do, but then haven't got a chance to really think through that. And then also, I think it's also lack of options. It's very interdependent economies around the world, it's all very, very much connected and globalized in a financial market. So then how do we even pick a strategic investment portfolio? Or basically that's what you're doing, right? So then you're offering the options and choices to investors, like us. I do want to shift the gear a little bit. In the earlier conversation, both of you have a little bit background on Hong Kong. So I am wondering if you would be willing to talk a little bit about like Hong Kong's current situation after the national security law, and then how investors or investment communities have viewed Hong Kong. Like, is there any change of attitude, or is there assessment or re-examination of Hong Kong's status as financial hub? So yeah, I'm just curious about that.
So thank you, Kathy, for bringing about Hong Kong, because Hong Kong is a real special case. Hong Kong is one of the world's financial center, global financial center after New York and London. And what the national security law has really, what it did is completely change the landscape of Hong Kong, whether it's just also an ideal place as a financial center, or it is actually becoming what I call the haven for money laundering. So right now, we do see that right now, what had passed, with Hong Kong just last week, the chief executive John Lee have gathered the world's CEO on like the financial institutions come to Hong Kong for the financial summit, because they want to attract global conglomerates and to show them what they call the best is yet to come. The past has ended already, and go in front, not behind. I think what it did is that whether Hong Kong is the same anymore or is being overshadowed by two things. First, the national security law, and the second, the tight control of the COVID-19 policies. And two things I have to say, they're equally political. What the national security law that is actually repression that after the Hong Kong protests, because Hong Kong is no longer a free place with the freedom of speech, freedom of association, and academic freedom. And most of all, it actually devastated the judicial independence of Hong Kong with the national security law. And what I do see that in the past, a lot of investors, they like to go to Hong Kong because it's always have been the gateway of China. But on the other hand, in the past, even though Hong Kong and its own core, one country, two system, they still have to play with the international rules. But now it seems that they have to play with the Chinese books. But what I'm saying is that right now, yes, you can still enter Hong Kong, but always comply with Chinese rules. Because what China needs is not just Hong Kong. They want the international capital where they can actually internationalize the renminbi, because Hong Kong has always been the biggest offshore renminbi center, and always it could actually support those countries under Belt and Road Initiative. But what I do see here is that what comes to the second point is that without the really judicial independence, while the Beijing could be a big boss to say everything about Hong Kong, is it still a safe place to invest? And the COVID-19 is a perfect example. What we had here in our basic law, which is our mini constitution law, is that, or mini constitution, is that Hong Kong has their own policy making, right? But then why Hong Kong is still having a tight control of COVID-19? Because the Hong Kong authorities have always to follow the rules of Beijing, which is completely a different case with other comparative like Singapore, which is a sovereign nation. But a lot of people be asking, when I actually invest in Hong Kong, I still have to quarantine for right now for 3 days. It seems that Hong Kong is becoming less competitive than our counterparts. It's all because of the Beijing authoritarian rules as well, because Beijing right now have a complete say about Hong Kong. Okay, so right now we do see that, yes, in the past, Hong Kong has always been a global financial center, but at the same time, we also see that Hong Kong is now being more susceptible and being more vulnerable to the money laundering as well. About last month, during right now we're having war between Ukraine and Russia, and a lot of Russian entities, they are currently being sanctioned by the United States. And actually, in this about 2 to 3 months, the registration of the Russian companies in Hong Kong have doubled compared to last year. And last month, in the same period, there's a Russian yacht belonging to one of the biggest, tycoon from Russia. They have actually entered the Hong Kong waters. My question is that why would the Hong Kong government allow that if it's actually an international financial center? Because it's actually completely violated the current sanction list of America, right? But the thing is, like John Lee, the chief executive, is saying that this is whatever, we do not comply with any unilateral sanction. We only comply with the bilateral, the multilateral sanctions here. But when it comes to the question of this is actually a very controversial question, because like a lot in like financial institutions, when they come to Hong Kong, they have to comply American rules in order to have their business operating in America and use the US dollars. And that's why the State Department responded. It would actually ruin, and actually it would affect Hong Kong as a role of the international financial center. And also give you some cases here about money laundering. In the past, Hong Kong has always been a special place because they were playing between US and China. Of course, even in the past, there are some deals with Iran, which is of course sanctioned by the United States. But now, because after national security law, it becomes more and more explicit when they are doing trade deals with Iran. For example, like in 2021 last year, the U.S. Department of Commerce actually sanctioned 7 Hong Kong companies. 5 of each actually is related to the money laundering in support of the Islamic Revolutionary Guard. And also, just like about 1 to 2 years ago, in 2020 in November, it was being there was an investigative journalism revealed by the Radio Free Asia that that 4 Hong Kong companies are being sanctioned by America, and a particular individual in Hong Kong, they have a company, 37 companies, 10 cruises, and 5 oil liners. They are actually related to some Islamic companies. Like there's one Chinese individual that actually founded companies in support of the Islamic Republic of Iran shipping line cruise, the IRIS. So whether Hong Kong is still a welcoming place for international investor, as a global financial center, or it's becoming a hub for money laundering. And this is the question I have here of Hong Kong after national security law.
Yeah, so the market also reflects pretty well, right? So back then in 1997, when Hong Kong was turned over to mainland China, to the Communist Party, the Hang Seng Index were around 15,000 points. So about 2 weeks ago, it actually got back to that level. So if there's anything that has not been changed in Hong Kong, right, whatever the government has been saying, the fact is that the Hang Seng Index indeed has been kept to be pretty similar after 25 years, to be still around 15 or 16,000.
Yeah. So it might be a great place for Iranians to do business or Russians to park their yachts, but it doesn't seem like Hong Kong, as far as public investment goes, is really welcoming or open with the new security law. So the numbers don't lie. So with that, I think we've about come to the end of our time here. Larry, Daniel, really great to talk to you. Really interesting product that you've developed with the Free World investment. I will continue to track it and see what your returns look like personally. Interested in it, and we'd like to keep in touch and see how you're doing, and maybe touch base again in about a year and see what your full year annual returns will look like. With that, any other last words, Larry, Daniel?
Well, so looking upon in the future, right, one critical mission that we would like to do is to actually get more people to be aware that their 401k or mutual fund ETF investment actually even though doesn't look heavily engaged in China. However, all these US domestic companies, a lot of them are actually heavily investing in China and also other countries that we do not want to invest in. So it would be good for people going forward to look into their portfolio and try to analyze the country risk and geopolitical risk over there. And hopefully in the future, then they would be able to execute their freedom of choice to choose not to invest in all these US companies, so that it would also guide US companies board of directors and also CEOs to be more conscious in terms of like investing in certain countries and be able to actually change their corrosive investment into constructive investment.
Yes. So yes, like the same, we would like to actually let more people know the current situation here, because actually people don't even know, they don't have a choice to know how much money they actually invested in authoritarian countries like Russia and China. And the world still, they're losing money considering how turbulent their stock market is. So right now, free world investment actually offers an idea, a concept, and a current portfolio that we can actually have the best of both worlds, where you can keep your money clean from these repressed regimes while we outperform the market. So for further information, just feel free to check out our website at www.freeworldinvestment.com. Thank you.
Amazing. Thank you both very much, and look forward to continuing the conversation and checking back in. Kathy?
Thank you, everyone. Just want to thank the listeners for tuning in for today's episode. We've got a lot of really, really interesting information. And another thing I do want to mention before we end the podcast is, so SIPE is going to release a report entitled Hong Kong Lost Its Appeal as a Financial Hub for Asia After the National Security Law. It's all about numbers and data. So it will be released over the next week or so. So stay tuned.
Democracy That Delivers has been brought to you by the Center for International Private Enterprise. For more information, please visit sipe.org.